Hi, Jim Yent from Golden Years Advisors, the home of the Kairos Formula. This is our third update for our fourth quarter state of the market. In our previous one, we just talked about inflation. So now let's talk about what will the Fed's reaction be to rising inflation. And the first thing that we all are aware of is that the Fed has communicated for months now that they're going to start tapering. That means they're going to quit their quantitative easing or QE process of buying both treasuries as well as mortgage-backed bonds. So on this chart, what you'll see is the Fed is probably targeting about a $13 billion per month reduction in those purchases. It might be a bit higher or lower, but it seems it'll be about that $13 billion mark. And it's about an 8-month process. So whether they announce it next month in November or in December is really not that material or relevant. But whenever they do, and this chart shows a November start, it's about an 8-month runoff. It means they'll be done by about the July timeframe if they start in November. Now, people are panicking when they talk about tapering because people confuse it with tightening. They're two different things. Really, there's too much liquidity in the market right now. People have been arguing that the Fed should have quit tapering over a year ago, but tapering is not tightening. Tightening is when you actually raise rates. Tapering just says there's less liquidity, less quantitative easing going on. So let's go back to history. It's the easiest way we can kind of look at this. The first time the US Federal Reserve ever tapered was in that 2013 timeframe. And because it was such a new thing, Chairman Bernanke was trying to communicate what he was going to do. And on the left side of this chart, you'll see that's him just mentioning that he was going to do tapering caused about a 5 to 6% decline in the markets. But then once the market and investors in general said, this doesn't sound that bad, it's tapering, not tightening, then we saw a rebound happen until when finally the tapering started. Once again, there was a pullback, it was about a 6% pullback, and once again, the market kind of absorbed that and we went to newer heights. So that's tapering. Eventually, there will be a tightening, and Chairman Powell, if he's still at the position next year, because he's up for a renewal, and we'll see whether he is renewed or not. When tightening happens, that was really in the 2015 timeframe. And on the gray line is what happened to high yields, and they fell the most. But the blue is the S&P 500, and the black is 10-year Treasury yields. Everything declined for the first, 90 plus days before the market kind of absorbed it, and we went to higher heights. So tapering, whenever it does occur, and they're trying to communicate that it is not a next year event. The market thinks there will be some tightening next year, but the Fed said not until 2023. So we'll see what happens. We won't know till we get there. But in any event, that's not the end of the world. So if concern about tapering and eventually tightening is overstated, how about peak earnings? Because you hear a lot about that. If we look at this chart, this is the last 3 economic downturns we had: the tech bubble, the mortgage meltdown, and then the COVID crisis. And the black bar shows how far the decline was for the S&P and then the bounce back of the S&P. But that yellow line is where peak earnings growth was. And on every example, after a big drawdown, we have a peak in earnings. But you'll see in every case, and we haven't done the COVID one yet, but for both tech bubble as well as mortgage meltdown, the yellow bar peaks and then kind of goes sideways for a while. If you look behind that, you'll see that S&P performance or returns still remain strong, even though there was a deceleration of growth. On the right side of the chart, it says we're always debating, are we early in the cycle or late in the cycle? When we first hit peak growths, yes, there is some kind of pullback often in those first 6 months, but as we go further out in time, 12 months and beyond, whether we're in mid or late cycle, we see strong S&P performance. So we'll keep watching this and monitoring it, but it's not till we get late in the cycle do we have concerns about more significant drawdowns. Moreover, what just happened in September was our first pullback. It was a small, just a 5% pullback in well over a year. What that really did was it lowered some of the overvaluations. If you look at the S&P, we went from an overvalued situation down to at least a fairly priced. Now we're springing back a bit, but as profits continue to grow, that PE, that price to earnings, that metric of are we overvalued or not, should stabilize. So that's it on the earnings front. Let's stay tuned for our next update.